Much for coming. Hello, everybody. Liz Ann, we're really honored to have Liz Ann Sonders on with us today. Her bio is relatively straightforward because she's been with Schwab for almost 23 years. And during that time, she's been the stalwart force and guiding light for customers of one of the most successful financial firms of this era. Schwab has gained the trust and confidence of one of the largest bases of retail investors in the business with 34 million. And it's only ever had one voice covering the US market. And Liz Ann, that's been yours. We invited Liz Ann on today to discuss the economic environment, the Federal Reserve, some characteristics of today's markets, and especially Liz Ann's outlook for 2023. Each week, Brendan, John Fagan, who unfortunately can't make it today, and I at Markets Policy Partners publish a 5-minute macro quick read. And we'd like to start, Liz Ann, by getting your thoughts on two that are likely to remain key drivers for an extended time. And that's the Fed's pace and ultimate landing zone for interest rate tightening and energy price volatility. Let's start with the Fed. They seem determined to reestablish a real cost of capital that's well above zero. And many skeptics have thought this would not be possible, that our economy had become addicted to monetary accommodation. Do you think the economy will be able to grow if the Fed funds rate levels off at 5%?
So here's my take on that question. I think the economy has actually been a bit stifled because of the current environment, obviously, 0% interest rate environment, bloating the balance sheet to $9 trillion. I think that generated to some degree an era of malinvestment, the lack of price discovery, if you even just look at the expansion from the aftermath of the global financial crisis to the pandemic, that was the longest economic expansion in US history. That's good. Not suggesting anything's wrong with that. The rub is that it was the weakest economic expansion by far relative to any other economic expansion. There are lots of contributors to that, but I think sort of suppressing price discovery and promoting indirectly, at least, malinvestment, I think has been a bit of a hindrance for the economy. Now, where there might have been more of an addiction to easy monetary policy was in markets, but I don't think that's really been the case in the economy.
Where do you think this is going to level off? The bond market is telling us that it's going to be a lot lower than what the Federal Reserve is saying.
That's a great question, especially after yesterday. You know, the equity market's having a rough day today, but the bond market just completely ignored what the Fed said yesterday.
Well, the bond market, I think, is still reflecting the most likely scenario, which is that we're in a recession or we're getting a recession. I happen to think we're already in a recession. It's just of the rolling variety because we have pockets in the economy that are already deep in recession, housing a lot of the goods segments of the economy. That's where the launch out of the lockdown phase of the pandemic occurred. Yes. That was the breeding ground for the inflation problem we're still dealing with. But that's now rolled over and we have the offsetting strength on the services side. So we're already in a recession. It's just a question of ultimately, when or if it gets declared in an official capacity by the folks at the NBER.
What are some of the characteristics of the economy if the Fed funds rate levels off at, say, 5%? What are the differences that we would expect to see in the performance of different sectors, or how do you look at it?
Well, I think the aggressiveness with which the Fed is hiking rates here has led to leadership shifts tied to that. I think one of those that is probably the most important shift that I don't think quite gets the attention that it deserves is leadership having been concentrated in the mega cap, techie, consumer type names, giving way to the average stock. So I think one of the things that's happened is we have price discovery again. We've got a risk-free rate again. It's manifested itself in equal weight, outperforming cap weight, active management doing better relative to passive, or at least operating on a more level playing field. I think the initial surge in inflation and the move off the zero bound was the real hit to the stock market, because it suggested that either extremely overvalued companies or longer duration companies, meaning their cash flows or profits were way into the future. Well, you actually have a risk-free rate again. You raise the rate that you're using to discount future cash flows, and if they're way out into the future, that makes them less valuable. So I continue to think that the best way to approach the market in an environment like this is to invest based on factors or characteristics versus trying to make a sector call or two. And the best way to think about factors in this environment is what's missing from a macro perspective, what's dear. We're in a declining earnings estimate environment. Look for companies that have positive provisions. We're in a higher interest rate environment. Look for companies that can self-fund, that have cash flows, that can either not even have to come to the credit markets to raise money. They can fund themselves through cash flows, or if they have debt, they're easily able to pay the interest on that debt. We're in a high volatility period of time. Look for lower volatility companies. Look for strong free cash flow yield. So that, to me, is the better way to think about what to do versus that traditional, what sector or two do you think is going to outperform versus underperform? I think it's the characteristics and screening for them, frankly, that you can apply across the cap spectrum, across the sector spectrum. And in this environment of fundamentals reconnecting to prices, I don't think opportunities will be so monolithic by having to make a cap call or a sector call or two.
On the Fed action, one of the things that gets less attention than the interest rate changes has been the balance sheet reduction.
Yeah.
When you look at the relationship between the balance sheet and stocks, it looks dire. Is the balance sheet reduction a more serious threat to the stock market than rising interest rates?
Not necessarily, and because there's so many drivers of what the stock market does at any point in time over whatever time frame you're talking about. It's more opinion and subjective to say, well, here's been the biggest driver of what the market has done. But I will say that the simultaneous shrinking of the balance sheet in conjunction with what's been the most aggressive Fed funds hiking cycle in at least 40 years is that the actual amount of tightening is greater than what's reflected in the Fed funds rate. And that's part of the reason why the folks at the San Francisco Fed created something they call the Proxy Rate, which is still an interest rate, but it incorporates into the base of the Fed funds rate, not just the impact of shrinking the balance sheet, but also embedded in the Proxy Rate, interestingly, is forward guidance. So the jawboning and how impactful that can be in this era of, the Federal Open Mouth Committee and press conferences at every FOMC meeting, there's a lot of power in their words, not just the lever they're pulling on interest rates or with the balance sheet. And with the 50 basis point move up yesterday in rates, and there is no update yet for the proxy rate, but even before yesterday, it was running 2 full percentage points higher than what the stated Fed funds rate was. So yes, it's having an impact, and you can see that by looking at this proxy rate, either instead of or in addition to the Fed funds rate.
And what do you think the future of quantitative easing, the expanding the balance sheet as a policy tool is? Is it something we're just going to get rid of?
I think that the bias is to continue to shrink the balance sheet. I think where the balance sheet might be used as a tool with maybe a pause in shrinkage or some other mechanism around which the balance sheet could be used, I think that will be only to combat serious financial system stress.
Yeah.
What I think the Fed and Powell in particular is really trying to make clear is that equity market weakness, equity market volatility is not the mandate of the Fed. And so that's why I wrote an article for the Financial Times, I think it was either earlier this year or maybe it was last year, about the Fed being put to bed, and that there needs to be a distinguishing on the part of the Fed, market watchers and participants should understand this, between financial market volatility and financial system instability. Yeah, when we didn't have to worry about inflation, we were in the era of the Great Moderation, you'd get turmoil in the equity market like in late 2018. Yeah, the Fed could step in and either via the balance sheet or lower rates or even jawboning, they could kind of ease that volatility, ease that stress. Well, not anymore, unless we start to see a true infection or a plumbing system problem. And as of this point, that's not something that they have had to contend with, but that's where they might pull the lever. I just don't think we're going back. I actually say, I hope in my lifetime, to a ZIRP, NIRP, negative interest rate environment in the case of many non-US markets, and a massive ballooning of the balance sheet.
And actually, I think the Fed's doing the exact opposite right now in terms of the S&P. I think they want the equity market to go down.
It's a feature of what they're trying to do.
But they don't want financial conditions to loosen. So I think so much of yesterday's communication was to try to talk down equity markets.
I absolutely agree, because we have seen a loosening of financial conditions. Now, in the case of August at the Jackson Hole confab, Powell really was forceful in telling the market that its narrative around not just a decline in inflation, but a move to rate cuts sooner rather than later. That narrative, in my mind, made no sense whatsoever, because the only environment in which the Fed would see a green light to start cutting rates would not just be inflation continuing to come down, but significant weakness in their other mandate, the labor market. And to your point, Brendan, they, weaker equity market, weaker labor market, and the impact that has on the economy, on financial conditions, as an ingredient in their mind in the recipe to not just bring inflation down, but get it to stay down sustainably. Many of these things, a higher unemployment rate, weakness in the equity market, they're features of what the Fed is trying to do, not bugs in what the Fed is trying to do.
Yeah, I did a webinar earlier today, and I said that, the Humphrey Hawkins testimonies are usually kind of boring, but the next one's going to have some fireworks at it.
It sure is. And these press conferences are really interesting to watch. And I was glad to watch yesterday and see that a reporter specifically asked about the likelihood of rate cuts anytime soon. And Powell could not have been more definitive in his no answer. That doesn't mean there won't be a point, maybe even it's next year, where the need for ease kicks in, but not without pretty significant deterioration in the economy more broadly or the labor market.
I also thought the question at the end, I think it was a Fox reporter, was talking about raising the inflation target. And I kind of keep going back to it. So much of the quantitative easing was to try to raise us out of the kind of low inflation environment that they're in. And now you're actually kind of had a perfect scenario if you wanted to do it, because of so much of the higher inflation was caused by the pandemic and shortages. But it doesn't seem like they wanted to take it.
Not near term. And I think Powell did, with the subtlety of his language,
he almost
say that, look, at some point that might happen, but it's not. The Fed currently is not on some mission to change the target. Now, what we don't know is if they express themselves in a manner that suggests, it's close enough, a two-handle.
Wasn't it New Zealand that set the 2%? It's kind of an arbitrary number.
It's a bit arbitrary, yes. It is a bit arbitrary, yeah.
Lizanne, you spoke about the last decade of zero interest as distorting investments. and that probably dampening or affecting growth. The other thing that probably is affecting growth is the massive fiscal deficit, not the deficit so much as the total debt. So the Fed raising rates to 5% may fix the malinvestment from the interest rates that aren't accurate or healthy, but that also winds up exacerbating this growth weight that the debt represents.
Yep.
How do you think that's going to play out? And that's part of the argument for those folks that say we're addicted to an accommodative monetary policy because we can't afford to have a regular interest rate base given that debt.
Well, I think politicians to some degree may be addicted to it in the sense that, and I say this as an equal opportunity critic of both sides, no one has been forced in Washington to have an adult conversation about this issue, because even though we've had this high and rising burden of government debt, it really hasn't mattered in terms of impressions of the kind of average man or woman on the street. It's not been what is top of mind for constituents. So it's the one thing that both sides of the aisle do incredibly well is kick the can down the road. They're really varsity players on that. But as now interest rates have been going up, the cost of servicing the debt is going up, and a larger and larger share of the revenues flowing into the government are going to have to cover that interest on the debt. So I don't know that I have some answer to what are the near-term implications. I just know it's going to be a bigger part of the collective conversation. And maybe the good news is it's going to force some more adult conversations in the halls of Congress about, okay, what do we do about this?
Yeah, it shifts one form of malinvestment to another in many ways.
Yep.
And so the level of interest rates and what you think about the rolling recession becoming a more serious recession, maybe we can start talking a little bit more about economic factors and the ones that you think are the most important and which ones swing the most if rates start moving up or down from where people expect today.
So, clearly what's already happened is the compression in the areas of the economy that drove us out of the very short-lived pandemic recession. And that, of course, was fueled by massive stimulus, both of the monetary and fiscal variety. That stimulus at the time, with the demand that it helped create, was forced to be funneled into the good side of the economy because there was no access to services, not just in the United States, nowhere. Again, it became the breeding ground for the inflation problem we're dealing with now. But since then, we're in disinflation on the good side, if not outright deflation in some components. The housing market broadly, but in many cases, some of the subsectors of retail, the kind of stay-at-home areas, are sort of an implosion mode, huge inventory problem. But the pent-up demand then kicked in on the services side, and services is a larger employer, hence the labor market being kept relatively afloat. Now, I do think that there are noticeable cracks under the surface that you don't really have to peel more than maybe one layer of the onion back beyond just payrolls and the unemployment rate to see those cracks starting to form. And I think the next important thing to happen is deterioration in the labor market. The feeder that will have into what the Fed is doing and will continue to do, the feeder through the confidence channel, that until maybe the retail sales report we just got suggested the consumer was sort of hanging in there. I think they were hanging in there, even though they were drawing down their savings, they were increasing their use of credit cards. But I think it was on the back of, well, at least I can be confident in the labor market, confident in my own job or getting another one. You lose that kind of crutch. And what tends to happen is things are not linear. It's almost like, the Roadrunner goes off the cliff. And for a while there, he's floating in the air and then straight down. And with the latest retail sales report, quite a bit weaker than expected, that may be a glimmer of that. Okay, now that I've burned down my savings and I've ramped up credit card use, if I lose that pillar of confidence in the labor market, retrenchment time. So I think that near term is the next set of variables to pay close attention to.
How about the energy market, which is, I guess, part of the commodity complex that's coming down so rapidly? I think it's better to characterize the energy markets as being volatile rather than good or bad.
Right.
And I don't know why the volatility is going to go away, because there still is a significant supply problem over the longer term. How does this factor into the economic outlook that you talk about and forecast with?
Well, some of the compression that we're seeing, not just in the energy space, but the broader commodity space, is reflective of a significantly more dour global economic backdrop and reflective of waning demand that comes as a result of that. But you're right. I think, expecting ongoing volatility, I think, is the right position, not just because of greater geopolitical uncertainty. Obviously, the Russia-Ukraine war, which can be a needle mover in either direction. I hope at some point we start to talk about a resolution and it being a tail risk on the positive end of the spectrum, but we're certainly not there yet. Then you get, weather impacts, especially if you're also talking about the food side of things. And then the real wild card as it relates to the kind of the demand side of what goes on in energy is the reopening by China. And frankly, it could go either way. I think that there are intelligent arguments on both sides of multiple debates in terms of, will they be successful? Will they have to lock down again? Will the pent-up demand come in force in a short time horizon, like was the case when the United States came out of lockdowns? And no one, lots of opinions, but I could be swayed in either direction. But I think the easy call is it's a wild card and probably means for more volatility. But from a kind of a fundamental driver, I think it's the reopening of China that is probably more important to the energy markets than any of those other forces that are ongoing.
Mm-hmm. It's unknowable because there's only one person that knows it.
President Xi.
Exactly.
But he does. Has no idea how people are going to react. You open back up in part because protests, and it's just been long enough, but because there isn't wide scale vaccinations, individuals are making their own decisions. To not go out or to go out, send your kids to school.
Epidemiologically, what's going to happen? A lot of people are going to get it, and older people are going to die. So then we're going to see what the reaction of the Chinese populace is to those deaths.
Right.
They wanted to reopen because they got to see that everyone's in Qatar watching the World Cup without masks.
Everybody's going to.
A lot of people die.
Every individual is going to approach the reopening differently. Based on past experience, fear factor, other health conditions, so. Yeah,
I totally agree. Yeah.
Who knows?
I have no idea how they decided we're going to let you reopen and we're going to.
Right. But that doesn't necessarily mean some rush of demand and consumption and investment. But we know it's happening. It's just
pull back because
absolutely we are seeing some of that.
Yeah, very interesting. That's why I love watching the energy markets, but I never try to trade the energy markets.
I will say as it relates to the energy sector, which has obviously been the power driver in terms of corporate earnings. Now, even if you just focus solely on base effects, just how the math works of year-over-year changes, that's where the sort of compression on the downside in terms of forward estimate revisions, I think there's going to be a lot more pain on that front. I don't necessarily mean pain, the stocks are going to get hammered. But I think we're sort of in the bullwhip now, the boomerang of the aftermath of a period where you had quadruple digit year-over-year increases, especially relative to the period where oil prices went into negative territory for admittedly a short-lived period of time and for lots of technical reasons. But that don't extrapolate this past year's massive energy sector gains into the future. I mean, simple math just says it's not going to happen.
Right. Yeah. 2022 definitely was different.
Without the energy sector, we've had 3 quarters in a row now where S&P earnings were down year over year.
Wow.
There were other sectors that had positive growth, but in essence, in simple terms, it was energy that kind of saved overall S&P growth and kept it in positive territory. Energy negative first 3 quarters of this year, and that'll continue.
And in stock market performance, that sector also dominates. I think electric utilities is second, and it's plus 1%, and energy is up 50, or I can't remember the number, but it's up significantly, and the rest of the market is all down.
It's a small weight in the S&P, which is part of the reason why if energy is on fire, it doesn't have the same impact on an index like the S&P versus if tech was on fire, just because of the huge difference in cap weighting.
What do you think is when people talk about don't fight the Fed and you want to buy when the Fed pivots? What is a pivot in your mind? What is it that as far as just the Fed is concerned, at what point is there a clear sign that the downside of the market should be less than the upside?
Wouldn't it be lovely if there was such a thing as a perfect sign? There isn't, inclusive of what the Fed does. If you go back to the early 70s and look at every rate hiking cycle, and then go to the point where you had the final rate hike, and then looked at how the market performed out, a year, 2 years after that final hike, the range of performance outcomes historically is massive, in part because there's a gazillion other drivers of what the market is doing and does, not just some, inflection point in Fed policy. There are times where a lot of the damage had already been done at the point the Fed stopped hiking interest rates. In many cases, the damage was still in the windshield, not in the rearview mirror. Now, you use the word pivot. Maybe it's just semantics, but the increased usage of that word, which really kicked in last summer, especially right around the mid-June lows and led to the 2-month rally into mid-August, was an assumption of a pivot to rate cuts. And we already touched on that. I think Powell made it very clear that that's not in the cards, save for a much more significant economic deterioration than what we see right now. So, the P word that then sort of it shifted to as the buzzword was pause. So there's the pause that will come first. And I do think that the Fed is accurately shifting from a pure rearview mirror approach, because they know not only is inflation a lagging indicator, they also know distinctly about the long and variable lags between monetary policy changes and impact on the economy. So I think they've appropriately kind of shifted their attention from the rearview mirror to the windshield. But the long and variable is really important, because there isn't some, kind of perfect model based on historical average of, when are you past the pain point as it relates just to monetary policy. And too many people on this subject or other subjects talk about an averages based on history. And I wasn't the first one to say this I'll get to in a second. I don't know who first kind of coined the phrase, but analysis of averages leads to average analysis. And so I think you have to be really careful, especially as it relates to Fed rate hiking cycles, because there haven't been tons and tons of them,
It's a great
which
point.
means it's not a
Just go
huge
look what
sample
happened each
size.
time. Yeah. It's
Yeah,
not
we've
that much
only
work.
had, not including this one, we've only had 13
Yeah.
in the history of the Fed. That's not a big sample size. So make sure you're looking at the full range of historical outcomes and not just an average, because the average isn't going to tell you anything.
Such an
Not to
important-
mention the unique circumstances of the current environment, the pandemic, et cetera.
Yeah. What do you think if yesterday the Fed, because they really don't want to cut. So if the Fed said, okay, Mark, you're right. We've hiked enough already. So we're going to pause, but we're never for the next 2 years cutting. What do you think the rates market would have done?
I think that it would probably have steepened the yield curve even more.
Even more,
I mean, inverted the yield curve
I know,
even more.
yeah. I keep going back and
Because
forth. I think you're right.
I think the long end, first of all, I think the bond market is often more rational
Yeah,
about what's going on than the equity market. and I think
equities are fun, but they're not.
the 10-year having gone from 4.25 to sub 3.5, I think is reflective of the weak economy that is still ahead of us.
Yeah.
And it's just a question of the severity of that weakness in terms of when the Fed goes from pause mode to easing mode. And it's the market, the narrative back in June was all it was going to take was a decline in inflation. And I think what he tried to message yesterday was, no, we actually are going to need to see labor market weakness as a necessary ingredient because of how that feeds. We have been really vocal about saying this is not the 1970s, the conditions, the backdrop, the nature of monetary policy, demographics, the gold standard. I mean, the list goes on and on of differences. However, what I think Powell and others want to try to avoid associated with the 1970s is fits and starts of monetary policy. Hanging the mission accomplished banner, easing policy, inflation's out of the bag again, we've got to tighten policy. They go through the same thing again. And that's ultimately what led Paul Volker to have to pull a Paul Volker. And so it's the reaction function that I think the Fed is taking cues from the 1970s for. And so the bias is going to be staying at the terminal rate until both their mandates suggest it's appropriate to start easing policy, not just the inflation mandate.
Yep.
Yeah, better to have a Volcker legacy than an Arthur Burns legacy.
Yeah.
Can you just ask Volker too?
That's right. If you got to look way up.
Very high. Yeah.
Oh my gosh, I've spent time with him in person in various, and it's just remarkable how imposing he is.
He's very.
Well, I love the picture of when you went from Volker all the way down to
way down to Yellen. I know. And sure enough, ZIRP, and now we're back on the upswing with Powell.
Oh, so it's not just don't fight the Fed, watch how tall the Fed goes.
Right. It used to be the Greenspan briefcase indicator. Now it's height of the Fed chair indicator. Very, very precise technical analysis being done here.
How about longer term thinking? Inflation, we've just gone through really decades of low and disinflation. Is this likely have we reset inflation higher, or is the bigger secular trend lower growth and lower inflation?
I think the great moderation's over. I think that ship has sailed. I think that's firmly in the rear view mirror. Now, we have to keep in mind that inflation is a rate of change. It's the inflation rate. It doesn't say anything about level of prices. So I think the inflation rate will continue to come down, but we have probably seen a level set that is higher than where we were before. And one of the quantifiable proxies for that has already kicked in, and I would say is something to watch to confirm that we're in a different secular environment, is a relationship between bond yields and stock prices. So from the mid to late 60s straight through the very late 90s, basically a 3-decade period, with almost no exception, you had an inverse correlation between bond yields and stock prices, because inflation volatility, concerns about inflation, even when it wasn't obvious in the inflation rate, kind of defined that 3-decade era, such that when yields were rising, it was usually a sign of concerns about inflation or actual inflation, with typically a commensurate hit to growth. Well, high inflation, weaker growth, that's not nirvana for the equity market. So higher yields, lower equity prices, vice versa. Fast forward to 98, 99, straight through, even beyond the pandemic, for the most part, you had a positive correlation, with only really 2 short-term exceptions. And that was because we were in a disinflationary environment. The concern was more about deflation than inflation. So in that era, when yields were going up, it was typically a sign that deflation risk was easing, not a sign that inflation risk was accelerating.
Excellent.
Also reflective of a stronger economy. That is nirvana for the equity market. The only 2 exceptions were around 2000 and 2006, where you briefly went into negative territory. In those cases, that was sort of a sign to the Fed that you may have gone too far. But those were exceptions, not the rule. I think we're more likely in a, call it an inflationary backdrop, where there will be more concerns about inflation. There'll be more inflation volatility or sentiment about inflation. That 30-year period was also an environment where the economy was more subjected to supply shocks, whereas the 20 years through the pandemic, we were more subjected to demand shocks. I think we're going back to something not exactly like the late 60s to the late 90s, but more in keeping with the relationship between bond yields and stock prices. And it helps to explain why both stocks and bonds got hammered in 2022.
Yeah.
We're optimistic about the bond market in 2023. So it works both ways, but I think that's an important secular shift.
And on the secular thinking as well, if we have, I'm thinking about GDP growth. So for the last several decades, we've had a certain level on average, and going forward, combined with the large fiscal debt and a normalized monetary policy, it would suggest that we should be rejiggering all growth estimates lower. Is that your view? And if
Not necessarily.
What is it about the economy?
I think instead of thinking, again, in terms of averages,
yeah,
I think what we're likely going to see is bigger swings, more volatility in metrics like GDP. And that was also in keeping with the environment that preceded the era of the Great Moderation. You had shorter cycles, meaning more frequent recessions, but you also, the sort of expansion phases were stronger on the upside, even though you had more recessions. That, I think, is the environment we're in. Now, yes, 10 years from now, 20 years from now, we'll all be able to do the math and say, what was the average growth? I just think there's going to be more variability around whatever turns out to be the average, that I think at this point, I'm not sure, even if we knew what the average was, that is the right way to think about what the economy is going to look like, because I think the variability around that is going to be more significant. And there's lots and lots of reasons for that. Global demographics, the fact that the rise of China into the WTO and as a force in deglobalization, so many of the forces that drove that era of the Great Moderation are already dead or in the process of dying on the vine. And so we're not going back to what it used to look like, meaning the 20 years prior to this recent period.
Well, to argue that growth should remain in the same level, you would have to be able to predict something that no one's ever been able to predict about economic growth. And that is, what is the next thing that's going to drive the economy? And you can never anticipate it.
Well, here's, I'm not suggesting that this is a forecast I think is going to be right, not wrong, but I do think once we come out of this period of uncertainty and the compression and growth that I still think is ahead of us, and get past this unique point in the cycle, I do think what could happen, and I think it would be a positive, is I wouldn't be surprised if the next phase in the economy was more capex investment driven versus discretionary consumption driven. And I think that would be a good thing. I think that's a better backdrop for the economy than one that is just driven by discretionary consumption. Certainly better than if discretionary consumption is driven off the back of absurd debt and leverage, like was the case into the housing bubble bursting in the in the mid 2000s.
Yeah. I was going to joke that on Friday we're saved because we invented free renewable energy with nuclear fission, but that is a great breakthrough, and it's not going to affect us in the next couple of years. But there is just a massive amount of technological innovation that is happening. It's kind of underreported. So I totally agree with you that there's just an amazing amount of things that we can put capex into that are going to change the world and the economy.
Absolutely.
And it's going to happen in the next 10 years. It's not going to happen in the next
That's right.
3 months.
And I think it'll be in different areas than just like tech as we think of tech right now. I think obviously there's going to be a lot done in terms of sort of green energy and renewables. We're living in this world of maybe policy ideas went beyond moved faster than the actual infrastructure, and everybody is coming to grips with that, hence the backlash on things like ESG. But there's no question that we're moving toward a very different world than where we were. And what's also interesting on that front, and I think one of the more fundamental reasons why the sort of ESG 1.0 is shifting to some new version of it, because in some places around the world, like Norway, my home country, my family are all originally from Norway, some of the greatest advancements toward renewables, a green future, sustainability have come from investments made by the traditional oil companies. Because they have the resources, they have the people, the technology, the science. So they're sort of,
they want to protect themselves for the day that there's no more oil.
So this idea that I'm not throwing out names as investment ideas, but that whether it's Exxon or BP or whoever it is, that's where some of the maybe interesting advancements, technology, certainly where the capital exists, that it may be on a parallel path with newer companies that are solely looking at the future and don't have that foot still in the, I don't even want to say in the past, in the current and past.
No, but you're dead right. Actually, we had a big breakthrough this year in terms of being able to drill down to tap the geothermal, and it was the mining companies that figured out how to do it.
Yep. Good point.
How about government and the growth of government? A lot of people also point this out as the regulatory environment has gotten more intense, and it also puts a weight on growth, economic growth. How do you look at that? And do you have any thoughts about how it would unfold in the future?
One thing that's interesting in terms of just the sort of layout and backdrop of Congress in the past 2 years is because of the power of the moderates. You might not get a sense of it if viewing traditional media or social media, where the loudest voices seem to be at both ends of the extreme. But there's been an increasing amount of power as it relates to the moderates. We saw it in things like regulatory policy, tax policy, where a lot of what many on the far left would have wanted to get done was not stopped by Republicans. It was stopped by, the mansions and the cinemas of the world. And so I think that there is a growing understanding, maybe more concentrated on the moderate end of both the left and the right, of the implications of what might be seen as sort of virtues by either extreme, but the reality of the economy and lags and leads in terms of impact. And so I think that that's kind of interesting. I don't know that it affects, election cycles yet, or gerrymandering or any of that stuff. And I'm not a, political strategist, but I think there's something interesting that we're seeing in terms of just not louder voices by moderates, but more compelling analysis by moderates.
And so this growing influence of moderates might suggest that a further encroachment or a further growth of government into the economy we may have seen the pendulum swing.
I think to some degree, yes. There's clearly not an appetite, frankly, not really on either side for, massive spending. That at least for now anyway, that ship sort of sailed in 2020, 2021 because of how much was put forth toward the pandemic. And Republicans were able to put through tax decreases. That's not a big platform on the Republican side either, of taxes need to come down more either on the individual side or the corporate side. So there really isn't this sort of push on either side for major changes on the spending front or on the tax front right now. That was very obviously not the case from 2017 through 2021 because of whether it was congressional control or the pandemic. So I'm not sure that we're going to see those extremes, which is another reason to think that we might hear more from the moderate voices than either end. I do think, though, that the revenue numbers are starting to come down. We had this huge revenue surge at the state level in government coffers because of just how strong the economy was launching out of the lockdown phase. Certainly in the state's case, a lot of that, excess, the surplus has already been spent. That's what they do. And now we're kind of on the downswing in terms of the revenue dollars coming in. At the same time, of course, you've got the higher interest costs. So I think there's going to have to be more, again, adult conversations about how to allocate, kind of a shrinking pie.
There's an ever shrinking number of voices that talk about monetary supply. Is that something that you pay attention to?
Oh, yeah. Now, it got skewed both on the upside and the downside because of the pandemic. So, M2 money supply is probably the most common proxy for that, had a short-lived jump to more than 30% year over year because of the double-barreled nature of the stimulus. That then basically we've seen the mirror image and we've seen a complete collapse. Such that we may be already near or at the worst part of this.
I heard
in real terms, money supply is in negative territory and is the weakest, is the lowest in the 63-year history of M2 money supply data. That doesn't mean it might not go a little bit lower, but at some point, you're going to inflect in the other direction. And I think probably without a horizon of the next, couple of months, I think the path of least resistance then becomes up, especially at the point where the Fed can pause, which is not to say they pivot.
Yeah, there are Wall Street analysts predicting that the deposit base of banks is shrinking, and that's a key component of M2, and that M2 is going to continue to dip significantly.
Yeah, there's probably more downside, but I think a lot of the pain is behind us.
Yeah. And does that impact the real economy more than it impacts markets?
I think it impacts both. That surge in M2 is why, unique to recessions in general, it was an unbelievable V-shaped bottom. Normally, both bottoms in the economy and bottoms in the stock market tend to be processes over time with fits and starts. It's rare to get just a perfect V bottom, and we got it both for the economy and the market. And it was just because of the sheer power, scope, and size of that stimulus, because of both the monetary and the fiscal side. I worry a little bit more prospectively about the liquidity environment as it relates to markets. We are seeing a significant lack of liquidity, and to quote Warren Buffett, when the liquidity tide goes out, you see who's swimming naked. As horrific a mental image as it is, I think SBF is clearly one of those naked swimmers, and I do think we're not through the ripple effects of that, but the crypto ecosystem doesn't have a lot of overlap with the traditional financial ecosystem, and that's why the contagion has not morphed. But this liquidity drain, I don't yet think has fully worked its way through even traditional markets, either on the fixed income side or the equity side. And it doesn't necessarily mean some, crisis or LTCM type collapse is coming, but an example is, since the era of QE and ZIRP, going back to the financial crisis, you've seen so much money go out the risk spectrum into much more illiquid areas like private markets. In fact, the cohort of foundations and endowments over that period of time shifted from what had been low 20%-ish in private investments, venture, private equity, private real estate, to 55%. And so I think another shift that's going to happen is that a lot of that money that went out the risk spectrum went into the less liquid, less transparent private markets, will probably find its way back into the public markets, both on the fixed income side and on the equity side. That's not a bad thing. That's sort of a good story potentially, but I'm not sure we're fully through that discovery process of naked swimmers.
Yeah, SEC Chairman Clayton, back about 4 years ago, when he still had that spot, was saying that the biggest issue that he was addressing was the shift away from the retail investor to be able to find growth opportunities, because the private equity market had expanded so much. Yep. And it crowded out a lot of the public market.
Right. That's right.
And the biggest problem was that all these companies are coming public after the growth spurt, and they weren't doing very well in the stock market.
Well, that's all part and parcel with these micro bubbles, spec-driven micro bubbles that have been popping in spectacular fashion. And it was fueled by this ample liquidity environment and 0% interest rates. And it really was this era of malinvestment and the lack of ability to actually do price discovery. And now we have a risk-free rate again, and equal weight's outperforming cap weight. Active managers are operating on a more level playing field with passive. That helps to keep concentration risk from really ballooning, and we're kind of exposing a lot of the weak links, and now are living through the environment of not every company, startup or otherwise, deserves to survive forever, because they can come to the capital markets and continue to finance the prospects of cash flows, 7 billion years in the future. So this is creative destruction. This is, Schumpeter is kind of, looking down or up wherever he is, depending on your perspective, and saying, yeah, this is creative destruction. This is what happens in cycles. And we sort of suppress that to some degree, not purposely, but that's what happens in a highly liquid, 0% interest rate environment. Not to mention pushing individual investors that really shouldn't have gone way out the risk spectrum. It forced them out the risk spectrum in order to generate something resembling a yield.
Yeah. We had a fascinating interview with value investor John Linehan from T. Rowe Price, who's also the chief investment officer there. And he was talking about going back over the 20 years he's been doing it, the part a decade ago that he wouldn't have, that he didn't predict accurately was how the largest, best companies could grow to become so large and dominant. And this environment that you just described sounds a lot like smaller companies are beginning to get their advantage back again.
I agree.
And one of the interesting things he pointed out was that the era of the disruptors, where a Netflix could come on and take over the media world, may evolve into the next decade of the decade of the disrupted, where a Disney can now incorporate streaming as Netflix only distribution arm, as just one of many, and the content that Disney has now they become more competitive. It's a fascinating idea. I don't know whether you've given it much thought, but
I don't follow individual companies in any way, shape, or form. I'm very much top down, 30,000 foot. But I absolutely agree with the premise, and I think one of the things we're starting to see happen is the value, lowercase v value, associated with companies that have cash flows, that have profitability, shorter duration companies that are self-funding, that actually can disrupt when you're in an environment where support for zombie companies is starting to die, if not already dead. If you've got 4% high yield turns into 8%, while rates are going up, and less tolerance for that business model on the part of shareholders, I think we see a weeding out of companies that wanted to be disruptors, but the financial math is very different now than it was when we were in a highly liquid zero interest rate environment. Now, I agree. I think in general, there are going to be lots of opportunities down the cap spectrum. However, the one thing I would caution to say an audience of stock pickers out there is, if you're kind of shopping for ideas, and you start with an index as a base from which to look at individual names, one thing a lot of people don't realize is that even though the Russell 2000 is, for the most part, the standard benchmark for small caps, 40% of the Russell are zombie companies. They don't have sufficient cash flows to pay interest on their debt. S&P 600, which is used less as a benchmark, but is also a small cap index, they have a quality and profitability filter. So it filters out a lot of the zombies, a lot of the crap.
Wow, that's great information.
So I'd say, just as a start point, a base of stocks, companies to kind of look at, you might want to focus more on S&P 600. There's other ways to screen for quality and all those things, and I think that I think factor-based investing continues to be the name of the game, more so than picking a sector or two, like monolithic type investing decisions. I don't think makes sense. I think you actually want to invest in characteristics or factors, as we call them, on Wall Street.
I see we are almost out of time. I have one last question, and that is, in terms of probabilities of the market, how are you setting up in your mind about the probabilities of people wanting to allocate towards equities and other risk assets?
So if we look at where exposure to equities is right now, of course, you need to look at various cohorts. The Fed's flow of funds data just came out very recently, and it's only done on a quarterly basis. So it's through the third quarter of 2022. And in part because of depreciation in the equity market, you have seen households' exposure to equities come down from what had been an all-time record high. So a slightly improved picture, but we're still in the top quintile in terms of all of history, in terms of equity exposure. The kind of levels of equity exposure that have existed at past, major bottoms in the market, we're still well above that. That doesn't mean we have to go all the way down there. The good news is on the more institutional kind of speculator side of things, right now, they've never been more bearishly positioned, especially in the options market, basically positioning sort of for a crash scenario. So and I don't like the term cash on the sidelines, but generically, if you think of it in those terms, it really depends on what cohort you're looking at. But I do think, I'll reiterate, I think maybe the more obvious shift that is happening is a shift back toward the public markets from the private markets, both by institutions as well as individuals. I think it'll be both on the fixed income side, on the equity side. So I wouldn't see that as some funnel that automatically is a positive for equities. It probably is more of a positive for fixed income near term. But I do think that this sort of equal weight, doing better, active, performing better, I think that's going to stay with us for a bit longer.
That is terrific.
If not much longer.
Yeah, if not much longer. Brendan, any thoughts?
No, this was a lot of fun. I'm really glad that you came and joined us.
Oh, me too. It was fun.
Too.
These conversations, an hour just flies by.
It really does.
There's no shortage of things to talk about, that's for sure.
It's good to do a little bit longer form because you can cover so much more material in so much better depth. So we really appreciate you taking the time, and we hope everybody enjoyed it as much as we did. Thank you, Lizanne.
My pleasure. Thank you.